So imagine you wanted to start a business, yeah, and you had a great idea, and so you plan it out, and you figure that, okay, to get this business started, I need, say, $10,000. Yep. And so what do? Well, maybe you call up friends or family, see if they got money. Well, next do you go to the phone book? Is there phone books anymore? I don't know. And you just start, or go knock on people's doors and just see, does anyone have any money? The chance that you'll get $10,000, especially going to strangers, is probably fairly minimal, right? We would like, perhaps, a place to go. This is the role of our financial system, and financial markets play a big part of helping get money from those that have to those that need. So let's have a little bit of a chat about what are financial markets. So as the name suggests, it's a gathering place, it's a marketplace for those people to come together. Who's coming together? People who need money, people who have money. People who have money we might call investors. People that need money we might call borrowers, might call investees. But yes, people who have a need for money. And now, one of the things that we want, maybe more holistically, or as a society in this type of arrangement, is for the money to go to people, that businesses or government that can use that money effectively, that can create value with that money, can multiply that money. If they can do that, it creates value for all of us. So how do we figure that out? Well, that's where financial markets come in. In particular, this is where pricing of our most common financial securities, stocks and bonds, that's where this comes in handy. Now, we talk about stock price, we say, okay, it's the price of buying one share in a company, for example. But it's really, at its core, the pricing of risk. That is, we're trying to understand through our pricing, how much would we be willing to pay for the benefits of that investment. The less risky, the more we'd be willing to pay. The more risky, the less we'd be willing to pay. Yeah. So that's essentially what we're looking to do when we're talking about these markets that have pricing mechanisms or price discovery. There's different types of financial markets. So the two main markets that we might be familiar with are our stock market and our bond market. In these markets, stock market businesses can sell shares, that is part ownership in their business. It's a way for them to raise capital, yeah? Then we also have bond market, which is businesses and government can raise money, but this in this regards, what we're giving to investors is not a share of future profits. Let's say, no, we're guaranteeing a return, what we might call interest, on the capital offered. It's a loan, yeah? Stock market and bond market together we call our capital markets. That is, this is the place where business and government go to get financial capital. Then we have a market we call the money market. This is also a place where companies and governments can go to raise capital, but this is just short-term capital. So a business can go to the money market and issue a 90-day bill, for example, sell that bill, get money, and then after 90 days pay the money back plus interest, let's say. generally they sell the security for a discount and pay back the full amount at maturity. So money markets and bond markets collectively might also be known as debt markets. Short-term debt, money market; long-term debt, bond market.
Now, eagle-eyed viewers may have spotted some familiar landmarks in this video, so to play the Where is Dr. Dan game, head over to my Substack to be the first to log your location guess. See you next time.